Even as the U.S. car market softens, Ford Motor Company's new CEO, Jim Hackett, managed to surprise investors with better-than-expected second-quarter results in his first earnings report as CEO. For more on Ford's earnings and the company's future, Bloomberg's David Weston spoke with the company's CFO, Bob Shanks.
You really beat expectations on earnings per share by a good margin, and you took up your guidance for the rest of the year earnings per share, but you did fall short on the pre-tax operating profit. How do you reconcile those two?
Well, we did have a solid adjusted pre-tax profit, as you mentioned, but what's behind all the numbers in terms of the net improvement as well as the adjusted EPS is a favorable tax rate. Our tax team here at Ford has done a fantastic job in anticipation of potential corporate tax reform at some point in the future to identify some measures that we can take to recognize some deferred tax assets onto our balance sheet related to foreign tax credits from overseas. And so that gave us a very low tax rate in the quarter, about 10%. It also gave us an outlook for about 15% for the full year. So that's what's behind that.
And what about the total, not the earnings per share, but the total amount of pre-tax operating profit for the year? Have you changed your guidance on that, where you're going to come out for the year?
Well, we've provided a range of guidance in terms of EPS, adjusted EPS of 165 to 185. If you go to the top end of the range, there's a very, very small change in terms of the PBT element of that, and that's really reflecting basically somewhat higher incentives that we see across the regions for the balance of the year, some additional warranty expense in North America, but then offsetting that is stronger results at Ford Credit, who had a tremendous quarter, up 55%.
And talk to us about margins. Where did you come out on margins, and what are particularly squeezing the margins for you right now?
Well, we came out at 5.9% for the automotive segment, and that was down on a year-over-year basis. And the biggest factor behind that has been commodities. We talked about that earlier this year. In the quarter, we had nearly $400 million of headwinds from commodities. We had nearly $600 million or so for the first half. We expect about $1.2 billion for the full year. So that clearly is one of the biggest issues. And then in addition, in the quarter, we had some unfavorable exchange, and that was in Europe related to Brexit, and also in Asia-Pacific related to the weakness of the Chinese renminbi. And we had a one-time gain on a sale of an NC last year that's not repeating this year. Those were the three factors that affected the PBT.
When you talk about commodity prices, we think about steel, of course, a major component of your vehicles. There are things pending right now in Washington that could actually increase the price of steel. How much could that affect Ford's bottom line?
Well, obviously, it depends on what happens. We buy most of our steel in the U.S., and so if there were actions and if the consequence of those actions were to increase prices in the U.S., that would have an adverse effect on us. Interestingly, commodity price increases that we've seen so far, the biggest portion of that has, in fact, been steel.
And talk to us about product mix, because that's been a big issue for all the automotive companies. How was your product mix in Q2?
Well, in terms of financial effect, we had a very, very positive product mix effect, and that was, as you were suggesting, fewer cars, more utilities and trucks, along with higher derivatives in terms of series and so forth. But that is a reflection of what consumers want. Consumers are moving away from what we call traditional passenger cars, and they are moving more into SUVs and into trucks. And that's not just happening here in the United States. It's happening in every major market in the world. So we're simply responding to what customers want.
That was Ford CFO Bob Shanks speaking with Bloomberg's David Weston. And now we're going to move on to GM, which also reported expectation-beating earnings. Bloomberg's David Weston and Jonathan Farrow spoke to CFO Chuck Stevens for more.
So what drove this beat on the earnings per share?
Yeah, I would say another really, really good quarter from a North American perspective. $3.5 billion of profit in North America, very strong margins at 12.2%. China equity income continued to be strong at $500 million. We had a record quarter at GM Financial. They earned $400 million. And importantly, we broke even in South America in a very, very challenging environment. So when I look at the overall business, obviously very, very pleased with the top-line results for GM. $3.7 billion of profit, 10% margins, but it was broad-based. The improvement year over year was broad-based, and we're very pleased with our first half results, which very much puts us on track to deliver the business performance that we guided to earlier this year.
Broad-based, at the same time, North America still is a major driver of General Motors' business at this point. So as you look at that as the Chief Financial Officer, how much of the profitability came from product mix versus units?
Yeah, well, obviously, trucks, crossovers, SUVs continue to be very strong and continue to drive a significant portion of our revenue and profit, which from our perspective is even, as we think about the go forward, even a better reason to be constructive about continued strength in North America. We're entering the heart of our product launch cadence. We've launched a number of new crossovers, just launched the Equinox through the balance of this year. We'll launch 3 new products, the Enclave, the Tunein, and the Traverse. And then on the heels of that, we'll be going into the next generation truck. So we've got a very, very strong product lineup centered at where the market's going and where the strength of the market is and where we earn a lot of money. So again, we're very optimistic about the continued strength in North America in 2017 and beyond.
Chuck, where are you on backlog of inventory at this point? I know that's been an issue. They've cut some production lines already. Where are you right now? Where do you want to get to by the end of the year?
Yeah, we ended the second quarter just over 100 days supply, pretty much in line with what we expected. As we talked about before, we've got significant downtime in the third quarter to transition to the next generation mid-crossovers, but also to start to prepare some of our full-size truck facilities for the next generation product. So the inventory build largely was planned in the first half of the year, and then will deplete in the second half of the year, partially through the downtime that in the third quarter. But frankly, we've also taken very specific action on passenger cars where we see continued weakness and taken significant production out in the first half, and we'll continue to do that to align supply and demand. I would say, David, even within that backdrop, we still expect to generate 10+% margins in North America for the full year. And when we look at our performance through the first half, we're very, very much on track from a North American perspective.
One of the things that we've talked about a fair amount now is steel, the importation of steel, because that's a big issue in Washington right now. How close are you following that? What effect could it have on your costs if there are substantial curtailing of steel imports?
Well, obviously, we're very focused on overall commodities and raw materials. At the end of the day, we've got a significant exposure to raw material cost movement, and steel is one of those. When I think about the impact in 2017 versus 2016, in the first half of the year, it's been a several $100 million headwind on a year-over-year basis. Obviously, we're continue to focus on that, and we'll work very closely with suppliers to mitigate whatever those impacts are. But raw materials and commodities have been a headwind to the business thus far this year.
That was General Motors Chief Financial Officer Chuck Stevens speaking with Bloomberg's David Weston and Jonathan Farrow.
Coming up, we stay on earnings and talk with the CEO of drug maker Eli Lilly, Dave Ricks.
You can see all the Bloomberg best stories at Best Go. This is Bloomberg.
News about mergers and acquisitions can make or break a company's stock price like little else. That's what makes Bloomberg's Deal of the Week podcast essential listening for anyone curious about the biggest issues in the M&A world. Host Alex Sherman has tackled everything from Uber's deal with China's Didi to the sale of Gawker Media and why no one seems able to buy Hershey. Find it on the Bloomberg terminal, Bloomberg.com, iTunes, SoundCloud, and whatever app you use to browse podcasts.
Reggie Caudill is Dean of the Martin Tuckman School of Management at NJIT, New Jersey Institute of Technology. He calls NJIT's management program Business with the Power of STEM, designed to train leaders who can put technology and hard data at the core of a business enterprise.
If we look at what's going on with the business world, whether it's healthcare or it's retail marketing, the idea of information and data decision making and being able to extract the real essence of what that data is trying to tell you, that drives the area of business towards technology. And that connection is best created when you blend the engineering and the mathematics and the STEM side of universities, that technology side, in with the business and management side. It's that tight connection that really differentiates NJIT and our business and management programs here from any other university.
NJIT, New Jersey Institute of Technology. Learn more at storiesofinnovation.njit.edu.
A green business report. Tesla has electric cars and now a solar roof. Just as with the cars, the first customers for the installations are Tesla employees. By selling to them first, Tesla says it hopes to work out any kinks in the sales and the installation process before offering it to a public audience. But it is taking $1,000 deposits at its online store for these smooth black and textured glass roof tiles that are virtually indistinguishable from high-end roofing. From most viewing angles, the shingles look like standard materials, but they